Well, U.S. natural gas futures gapped lower on Friday, pulling back after Thursday's sharp and somewhat unjustified surge to multi-month highs. The rally increasingly looks like traders scrambling into positions ahead of the delayed EIA report rather than responding to any meaningful shift in fundamentals. And once the data finally hit the tape, it quickly undercut the bullish narrative. The EIA posted a bearish 45 billion cubic feet build, far above the 5-year average of 35 billion cubic feet and even larger than the 34 billion cubic feet forecast. With inventories continuing to swell more than expected, the market's elevated pricing starts to look even more questionable, and Friday's gap down feels like the first crack in that optimistic narrative. Despite the market's relentless 2-week speculative surge, the underlying fundamentals are actually shifting in a far more bearish direction, and today's storage report only reinforces that disconnect. The latest update indicates that the storage surplus is set to expand even more quickly through the second half of November, especially with the series of unusually small withdrawals projected after November 14. By the end of the month, the surplus is now expected to balloon to 197 billion cubic feet, a level that hardly supports the narrative of tightening supply that bulls keep pushing. For those in the comments accusing me of being too bearish, this is exactly why I remain skeptical of these elevated prices. I'm not fighting the market for fun, the data simply doesn't justify the froth. You can ignore fundamentals for a while, but eventually reality has a way of catching up and punishing the speculative crowd that convinced itself price action alone is a thesis. Meanwhile, weather models continue to emphasize an extended stretch of mild air and soft demand through Sunday. Even the slight uptick expected early next week looks fleeting and hardly enough to shift the broader pattern. Most major models keep the western U.S. unusually warm for mid-November, with daytime highs hovering in the 40s, 50s, and even low 60s in some regions. For a market that desperately needs sustained cold to justify its elevated pricing, this kind of warmth is exactly the scenario bulls didn't want heading into the back half of the month. From a technical perspective, the bulls had control of the momentum until now. But with today's disappointing EIA report and weather models trending warmer by the hour, the technical picture is starting to crack. A clean break below $4.45 would likely open the door for a retest of $4.30 and $4.15. Beneath those levels sits the real battleground, $4, where the 50-day moving average draws a clear line in the sand. Overall, as long as prices remain anchored above $4 and the weather pattern finally delivers meaningful cold, the bullish case isn't completely off the table. But if the next supposed cold shot fizzles like the previous ones, this overextended rally could unravel surprisingly fast. Nevertheless, I should remind bullish traders that La Niña is expected to shape this winter's weather, typically bringing warmer than normal conditions to certain U.S. regions. I'm planning to release an analysis soon on how La Niña could impact natural gas demand and prices. Please don't forget to check out the ads and leave a comment to support the channel. See you next time.